Before we begin, let's walk through our webinar platform together. Each of the buttons at the bottom of your screen relate to sections in the ON24 console. The speaker view is where you will see our presenters throughout the webinar. The slide view is where you'll see the accompanying slides. You can resize these widgets for a larger or smaller view. You may also follow along with a PDF version of the slides that can be found in the Related Content widget. In the Related Content section, you can access any accompanying materials for this webinar. This includes a PDF copy of the slides and many times will often include related resources. Using the Reaction button, you can react to content throughout the webinar. Reactions from our audience throughout the webinar will float along the console screen. Use the Q&A section to ask questions directly to our speakers throughout the presentation. In the Speaker Bio section, you can find out more about our presenters, including their contact information. If you need technical assistance, please use the Help button below. Many times, technical issues can be resolved by opening the webinar in Google Chrome or refreshing your browser. Finally, the Evaluation button contains our post-webinar evaluation survey. Here is where you can share your commentary and feedback on the presentation. We hope you enjoy our free webinar. Now, let's get into today's topic.
All right. Hello, everyone, and welcome. Thank you for joining us for today's webinar, Cash is Mission, Nonprofit Budgeting and Forecasting Essentials. Carol and I are both really excited to be here with you all today. It has been our pleasure to work with nonprofits and for-profits for more than 30 years, and we are really happy for the opportunity to share our passion and our experiences with accounting, really fun, right? Cash management and best practices for budgets and forecasts. First, we're just going to introduce ourselves, tell you a little bit about us. I am Jen Blasi. I am a CPA and a CFE. I have been working with nonprofits for more than 12 years. I started my career in public accounting as an external auditor, and I also spent about 10 years working on some pretty high-profile financial statement fraud cases as a forensic accounting consultant. With me today is my colleague, Carol Santilli.
Hello. Yes, thank you very much, and welcome to our friends, people who have been with us before here at YPTC webinars, as well as those who are new to it. I am also a CPA. I have worked in public accounting. I was there for 13 years before I moved into the mortgage industry and then the real estate industry. I have specialized in nonprofits as well as professional services type companies for almost all of my career. And I've been with YPTC for over 7 years. So a little bit about YPTC, or your part-time controller. We are a professional services firm that has specialized in nonprofit financial management for over 3 decades. With the goal of helping our clients sleep at night, our services include day-to-day accounting as fractional CFOs, interim controllers, and part-time bookkeepers. We support financial reporting, forecasting, budgeting, data visualization, and best practices, just to name a few. We have over 800 staff members helping over 2,000 clients in 13 regional offices, as well as providing services remotely throughout the United States.
Thank you, Carol. Just a few quick reminders from the video that played at the start of the session in case you missed it. We are going to be using automated attendance checks throughout today's session. So when these pop up, you'll hear a ding. And at that point, please click directly on the screen on the attendance check prompt, especially if you want CPE. Our marketing and training support team members are here, and they will respond to CPE questions and other troubleshooting in the Q&A. So please drop your questions there. And Carol and I would also love to hear from you today about non-troubleshooting topics. So please feel free to also drop any thoughts, comments, questions in that Q&A throughout today's session. We'll try to get to as many as we can during the presentation, and we're happy to hang around for another 15 or so minutes at the end for final questions. And finally, our slides and other resources are available for download in the Related Content widget, so you can check those out. They will also be emailed to you after the event. So we're going to be covering a lot of ground today. So if you want a more foundational type session on budgeting and forecasting, please check out our other resources in that Related Content widget or on YPTC's website. So today we're going to discuss budgets and forecasts and how these tools can be used to help manage your organization's cash, steer your mission, and also how to make smart operational decisions. So we're going to also focus on some key areas that nonprofits should be considering when budgeting and forecasting. And at the end, we're going to share with you a 90-day action plan as a takeaway, as well as a list of key questions that your budgets and forecasts should answer, which you can take back with your teams to work on.
So let's get started. And we'll start with a brief discussion, what we consider a brief discussion about cash management, since this is the backbone of financial stability.
So we understand the challenges you all face as nonprofit leaders, and I'm sure many of you can relate to some of these that we have listed here on this slide. As we all know, a nonprofit's ability to carry out its mission really depends on having sufficient access to cash or cash on hand. Cash inflows and outflows occur at different times, and our cash inflows, unfortunately, often lag behind our outflows. So for nonprofits who are relying heavily on individual donors or maybe grant funding, that revenue can be pretty hard to predict, both the timing and the amount. But at the same time, funding payroll is always a priority, and that need is going to occur throughout the year. So unless there's a cash reserve or cushion that you have, a nonprofit could really struggle to fund payroll or pay essential vendors when that revenue is arriving late or falling short.
And cash challenges rarely appear suddenly. They usually build over time because assumptions aren't monitored, responsibilities aren't clear, or projections aren't realistic. So this is why cash management is very necessary. It needs to be consistently predicting, tracking, and controlling your cash flow, especially when your revenue is seasonal or restricted. So we're going to talk about a few practices and policies here. One of the most critical practices is completing your monthly bank reconciliations. For every account that holds funds like PayPal, Stripe, or Venmo, you should be completing a bank reconciliations, because reconciliations ensure that you're accurately reporting, excuse me, and you help catch missing duplicates, you're missing transactions, you're catching duplicates, your unusual transactions, making them a key defense against errors and fraud. Strong cash management also includes diversifying revenue, separating restricted from unrestricted funds, and maintaining clear disbursement and collection processes supported by internal controls. A strong liquidity policy sets expectations for how much cash or reserves should be maintained. We typically recommend 3 to 6 months of operating expenses should be maintained in a reserve. And that your policy also outlines when and how backup resources like a line of credit may be used. An investment policy guides how operating short-term and long-term reserves are allocated and monitored, and ensures investments align with the organization's mission. And when we layer in cash flow monitoring, these practices help reduce the risk of fraud, especially in a world where AI can produce deep fakes, synthetic identities, and highly convincing forged documents. And with that foundation in place, our focus today turns to budgeting and forecasting, the tools that translate these policies into everyday financial decisions.
So let's start with budgets, since budgeting leads to forecasting. So we know that some of you are new to budgeting, so hopefully you learn a lot here today, and others may be here for just some fresh ideas. So feel free to share your experience in the chat as well. And hopefully after listening to us for the next hour, budgeting will not seem so stressful. So we will be sharing some visuals, and while we don't have templates that you can download, as I mentioned a few minutes ago, you will be receiving a copy of our slides. So let's get into it. What exactly is a budget? So a budget is going to be all of these things that we're putting here on this slide. So a budget is a plan, it is a roadmap, it is a foundation for data-driven decision-making. A budget should track all of your activities, including your revenues and expenses. And your budget will be a strategic tool for achieving your mission. It provides context, so you'll want to compare it against your actual results. And finally, it should be static. Budgets are essential. Your funders and your auditors are going to want to see them.
So I want to emphasize that last box there, number 6. The budget is static. You're going to hear us say this over and over again in our presentation. Your budget should not change. Think of this as your starting point. It's your best estimate based on the information you have available to you at the time you prepared your budget. Any updates or new information learned during the course of the year really belong in your forecast.
Great point, Carol. Budgets and forecasts are not the same thing. So there's a couple different types of budgets that you can create and monitor for your organization. So there's operating budgets, program, project, grant budgets, and capital budgets. We are going to focus on the operating budget, and that is the annual plan for the organization's revenues and expenses. And the emphasis there is on annual. We are talking about the upcoming fiscal year, which is a 12-month reporting period, and that may or may not match the calendar year. So Carol, I don't know about you, but that second bullet point we have here, I know I have definitely worked with a few organizations who are a few months into their new fiscal year before they approve their budget.
Yeah, unfortunately, I've seen that too. I've worked with clients who they didn't start their year with an approved budget. And it's really tough to be able to operate in a new fiscal year without a plan, because you're basically then flying blind until you create that expectation for the year. And by the way, if you're approving a budget a few months into your fiscal year, your budget should then reflect that current information.
Which sounds like more work to me. So I also want to mention budgets should be prepared on the accrual basis, which is GAAP, those generally accepted accounting principles. And that means we should be projecting our revenues when earned and our expenses when incurred, not when cash is flowing in or out. A cash basis budget sure does sound easier, we get it, but it does create unnecessary variances when compared to accrual-based actual results. So do yourself a favor and budget on the accrual basis and then reconcile to cash. Very similarly, you want to be comparing apples to apples all year long. So your budget should reflect the same line items for revenue and expense that you report in your monthly financial statements as well as your annual audit. And that includes consideration of both unrestricted and restricted revenues. So Carol, let me ask you, how often do you see organizations prepare only the unrestricted budget?
Yeah, probably all the time. And we're going to talk a little bit about that throughout this presentation. We'll represent some of the pitfalls. The problem with it is that it leaves out a big part of your relevant funding. You can miss the big picture by budgeting that way. Your restricted funds represent future pipeline. So those funds need to be considered for future spending. Those restricted funds may also overlap your fiscal year. So when you're excluding restricted funds, it again creates those unnecessary variances, making it harder to compare results accurately throughout the year. So keep in mind that your budget should reflect all your activities going on in your organization.
That's right. We want to see those 3-column P&Ls even for your budget. And I'm just going to quickly mention cost allocations. That is a more advanced budgeting element. And once you feel more comfortable with your budget process, you can budget by function, meaning do budgets for your programs, admin, and fundraising. And you can allocate shared costs across them. So this lets you evaluate performance by each of those areas, helps you spot funding gaps, and can also plan your fundraising more strategically. But Carol, how often do you see this in practice?
So this really depends on the sophistication of the nonprofit accounting team. Obviously, it's a great goal to strive for. As we know, or at least you should know, many funders and charity watchdogs are looking at nonprofit functional expenses. They're looking to see that a ratio of 75% or more are being spent on programs, right? So what does that mean? Exactly what I'm trying to say here. Nonprofits are spending more than 75% on their core mission and 25% or less on their management in general and fundraising. So since we know that, this is what they're looking for, that this is a key metric that they're looking for, it would be beneficial for your budget to be prepared that way with those outcomes. Okay, so I think I saw in the notes about, or in the Q&A a question about this. So hopefully this answers your question. So let's talk about who is involved in developing and monitoring the operating budget. And the simple answer is all of the people that you see on this slide, and maybe even more depending upon the size of your organization. You may need to involve your facilities team, your HR team, your IT team. You need to hear from all the people who are actually doing the work. You need them to buy in to what the budget's going to be, because then you want to hold them accountable to that budget. So let's look at the development box, right? So when you're looking at the development box, we say there that they're responsible for your fundraising goals, and that means your contributions, and that means your galas and things like that. They have that responsibility. But if you don't have that development person, it does fall on the ED and the controller to estimate that activity. And this can be true for the program activity as well. The key to note here is that the controller should not be creating the budget on their own if you have all of these other people. Collaboration and communication among departments is key to successful budgeting process. People often wonder where the boundaries are for management versus the board when it comes to budgeting. Hopefully, again, this slide helps clarify that question. Management creates the budget and executes the budget. The board, their role is to review it, ask questions, understand it, and approve it. So throughout the year, the board should understand and help monitor and address budget variances. So let's look at this overview here on this slide here. This is just a quick overview of the budgeting process at a very high level. And what we're going to do is we're going to look at each of these 3 steps one by one. So creating your budget. There are many different ways to create an operating budget. Whatever approach you choose, keep in mind that no budget is going to be perfect or exact. So listen to that again. No budget is going to be perfect or exact. You only have so much time and resources to plan your budget, to draft that budget. So we actually recommend taking a step back first, think big picture, get the major pieces in place, and then chip away at the details later. At YPTC, we call this the marble statue approach. Start simple. Look at your major inflows and outflows. Your outflows are your main revenue categories. Your outflows are your major expense categories. Depending on your organization's activity and/or mission, you should be considering all or some of the items we have listed here on the slide.
And Carol, we also want to emphasize that when you are developing a budget for your key inflows and outflows, it's critical to document the budget assumptions. And you might want to use separate supporting schedules for those. That can be really critical when you're later going to compare your actual results to budget. You need to know how you derived that budget in order to help explain the variances.
So Jen, that leads into our brief discussion on a few of the key nonprofit specific considerations of these inflows and outflows.
So brief, huh, Carol? Well, I will say it's not easy to talk about budgeting for contributions and grants briefly, but we'll give it a shot. This is probably the most challenging and unique area to budget and accurately for and forecast for, because these are so hard to predict. There's so many things to consider, and so we've tried to capture some of our key tips on this slide. So Carol, I'm going to ask you first, how many times have you seen organizations budget for their contributions and grants simply by increasing either last year's budget or this year's current results by a certain percentage?
Too often to mention. And worse yet, I've seen many organizations just plug their contributions to wipe out any deficit. And we highly recommend against doing that, because when you take that approach, it ends up causing stress on your cash flow, because there's no plan on how or when those funds are going to come in. And look, we get it. It's not easy to predict individual donor gifts, but it's critical to make estimates by month for managing your cash flow. And this is another example of why it's so important for the organization's development team, if you have one, to participate in the budgeting process, because they're ultimately the ones who should be able to provide the greatest insight and be held accountable to that line item. And as we know, it takes time to cultivate donors and develop relationships. So it's critical to be realistic with your budget assumptions.
Yes, we really can't stress this enough. So budgeting by month, it's so important. Those annual budgets can hide cash flow gaps, even if they seem like they're realistic in the aggregate. You have to make sure you can get to it by the end of the year. And that's why our number one tip here is to create that plan. We want to document those key assumptions that support the plan. So let's take a look at how this might be presented clearly in a supporting budget schedule. All right, so you can obviously use whatever type of format of schedule that would be helpful to you. This slide is based on something that an organization I work with does. And I really like it because it highlights how accrual-based revenue recognition often doesn't match actual cash flow. So for instance, contributions and grants may be recorded as revenue before cash is received, which would be the case for pledges and multi-year gifts, like in our example here for donor C. I think we have the animations backwards. Alternatively, you may receive the cash first before the contributions and grants can be recorded as revenue, as is the case for conditional grants, also known as refundable advances, like in our example for Foundation A. To complicate things further, some funders may pay in multiple installments, while others may pay on a reimbursement basis, where you have to put out the money first, submit invoices for reimbursement, and then wait. That can take some time, and we know that many organizations felt this during the federal government shutdown and when state budgets were delayed in passing. So you can see timing differences reflected in our example here for government grants. And Carol, I know you're probably thinking something to yourself like, Jen, this looks like a lot of work. Is it really necessary to be budgeting for pledges and conditional revenues? You can see it on your face. These are things we're not purposely seeking out. And I will say, Carol, that's a great question. And I do have a response, and that would be yes. And here's why it's helpful. If you know you have these things, budget for them. It can be very simple. We want to avoid unnecessary variances. Another reason, without this level of detail, someone might mistakenly assume that all of this budgeted revenue is going to increase your cash balance during the budget year, which is not always the case. We could probably go a step further and assign probabilities to the likelihood of receiving these grants and in what amounts, but we'd be here all day. So instead, the key takeaway, please consider all of these nuances because they directly impact your cash flow management.
All right, so the next budget area that is specific, I will say, to nonprofits is special events. This is another great area for your development team, but it will fall again to your ED and controller if you do not have that development team. For those of you who hold special events like galas or fundraiser like golf outings, here's an example of what a fundraising event budget could look like. Key assumptions you'll want to consider and document. These items include the number of guests. How many people are you planning to invite to your event? The number of people may dictate where you're going to have the event, which will also lead to the ticket prices for the gala or the fundraiser. You'll also need to consider sponsorships. How many levels and at what dollar value? And what about those day of event revenues like auctions and raffles? All of this leads to a discussion on what your direct event expenses like venue, food, beverage, entertainment, etc., things like that. This type of detail can help you proactively plan how to achieve those net revenue goals. So you need to take into consideration that you are front loading the expenses, right? We talked a little bit about this in the beginning, where you're paying those expenses before the event even takes place. What will the impact to your cash be for those special events? Also, what happens if your event crosses over the fiscal year end? This is another consideration you need to take into, you need to consider rather, when budgeting for these special events. Earned revenue, another area to be considering when you're doing your budgeting. And just a quick reminder, similar to for-profits, earned revenue is revenue you generate by providing goods or services. So it's a reciprocal transaction where the primary benefit goes to the customer. It's revenue that is recognized as it is earned. So the examples are listed here on this slide, and I'm only going to highlight a few. Okay, the complexity of budgeting for earned revenue can be the timing. Each of these items have a seasonality impacting the recognition of the revenue. So for example, tuition. Tuition is predicated on admissions. How many students will be enrolled? Do you have different tuition levels for different grades? How do scholarships and tuition assistance factor into your revenue? Typically, tuition is earned over the 9 or 10-month period of the school year. What budgeting considerations need to be made for the months that tuition is not being earned? Another example is ticket revenue, which is earned when the show performance takes place. What's the timing of the show? How many shows are planned? And let's hope that that show is fantastic so that each show is sold out. Another example of earned revenue has a seasonality to it, and its budgeting complexity is running, the seasonality represents another complexity for your budgeting, and that is the summer camp. So this summer camp program can fill the gap for the institutions with the tuition break, but it has the same budgeting factors to consider. So you have the number of campers, you have the weekly fee, and the number of weeks that the camp is going to run. So to sum it up, you have to have a realistic, well-supported, earned revenue plan to help you better anticipate when cash will actually be coming in. And it will help you explain those budget to actual variances as well. Timing, volume, and variable components of earned revenue are important considerations. So now let's take into consideration some of those key outflows.
So this shouldn't be a surprise, payroll, right? So payroll is typically the nonprofit's largest expense. So it's really important to build a detailed personnel budget. So this is another area where it would make sense to involve all departments in the process. However, we get that, that might really depend on how much transparency each department has into the payroll details. So to get started, build upon your current roster and add planned raises and bonuses for existing staff, add on, existing vacancies that still need to be filled, and add on the new positions planned for the budget year. And don't forget to budget for employer payroll taxes and the cost of your fringe benefits, like your medical and dental insurance, 401k matches, workers' comp, etc. So if you calculate these components individually, rather than just increasing your current payroll by a certain percentage, that will help increase the accuracy of the budget, and it will also help make future adjustments easier to implement. Other key considerations for budgeting for payroll, you want to plan for timing differences. So if you have 26 pay periods in a year, you're going to have 2 months that have 3 pay periods, and that's a higher cash need that you're going to want to plan for. And you'll also want to document any cost allocations by department. If you've gotten to that point where you're budgeting by department and allocating costs, you want to make sure you document that methodology. All of these things will really help ensure smoother cash management.
On this slide, we're highlighting a few other key considerations to keep in mind when developing your budget. On the inflow side, consider items such as the use of an endowment draw and the use of a line of credit, both of which can support cash flow if needed. These don't function like regular operating revenue, so they deserve special attention. For example, the endowment draw may impact restricted revenue before ultimately impacting unrestricted revenue. You need to budget for that activity so that you have a true picture of the revenue impacts. The line of credit activity doesn't flow through your statement of activities, but you may need access to the line of credit if you and/or your board anticipate a gap in cash or worse, a budget deficit. In the outflows section, we highlight what is typically the largest non-cash item in our budget, depreciation. And I think I saw a question about this also. This activity affects the income statement, but it's non-cash. Some organizations may choose not to include this in their budget, which is going to create an ongoing variance if you are depreciating monthly, which we recommend. We recommend budgeting for non-cash items like depreciation and adjusting for the impacts in your cash flow projections, which we will discuss later in forecasting. You'll note that we also have on this slide in kind on both the inflows and the outflows. Even though this has a net zero effect typically on your budget, you should include it in your budget because the in-kind services or goods that you're receiving would otherwise have to be paid for by you out of your cash, right? So lastly on this slide, it reminds us about timing differences. We need to think about the timing of receivables and payables because not all inflows and outflows hit cash when they hit the income statement. These timing differences can meaningfully impact your cash planning, and you'll see some specifics of this in our forecasting discussions. These items are important to monitor so your budget reflects both operational activity as well as cash realities.
All right, Carol, believe it or not, we are still in step one, creating and assembling the budget. But don't worry, things are going to move faster now. Now we've completed budgeting for our major inflows and outflows, and we're ready to assemble. So we encourage everyone to leverage your accounting system and available technology to streamline this budgeting process. Many budgeting tools exist, but because they vary in cost and complexity, it's really important to evaluate which options best fit your organization's needs. And I think I saw in the questions, somebody had asked about this. So at the end of our slide deck, we have included a list of some budget tools that we've seen some of our clients leveraging to help them automate their budget process. But again, start first by looking at the budgeting features that exist within your own accounting software. Systems like QuickBooks, for instance, often offer basic built-in functionality that might be sufficient for your needs. If your software or other technology, however, is not efficient or affordable, you've always got Excel. Always fall back on Excel. You just need to start somewhere. So don't stress. What matters most is that you can present your board with a clear, well-supported budget summary that includes some detailed schedules and assumptions, such as the comparative information shown on this slide, which can easily be pulled together in Excel. And we mentioned this previously, but we want to reinforce this with a visual. Break that annual budget down by month. So important. So the most simplistic approach, which we call our peanut butter method, is to spread that annual budget evenly over 12 months, which most accounting systems can do automatically once you enter an annual budget. From there, you can adjust the monthly amounts to reflect the expected timing of your revenues and expenses using those assumptions you already developed for the key inflows and outflows. So many organizations get to this point and then they stop here, but we are not done yet. This is just the completion of step one. So Carol, tell us what's next. What do we do next?
So now that we have finally assembled our budget, what story does it tell? As you evaluate your budget in this step 2, does it meet your organizational goals? Does it result in a balanced budget, a deficit, or a surplus? We definitely do not recommend deficit budgeting. We do it here in our example to emphasize the point. Generally, funders and board members do not like deficit budgets. If you are not budgeting for the release of your restricted funds, your unrestricted budget could be negative, and that could be misleading. This is where reconciling your budget to cash is critical to your planning. And we're going to cover that again in the forecasting section. So this is another reminder never to plug a deficit by inflating your contribution goals. That approach is often disastrous and can lead to emergency cash shortages with no plan for resolution. Another note, ongoing deficit budgets should be a red flag. Management and board should take action to achieve a surplus budget.
I was hoping to see a bunch of like applauses and heart emojis going up when you said, don't plug a deficit by inflating contribution goals. I hope our development people out there are applauding that. Finally, we are at step 3 of the budget, which is actually going to be 3 more steps. Approve, implement, and monitor. So if we go back to our roles here, the Finance Committee often reviews and approves the budget first. Then the full board should also review and approve that budget. And make sure that those approvals get documented in your board minutes. Next, you're going to want to distribute that approved budget to the appropriate staff. And again, those are all the people that Carol mentioned on that prior slide that are going to be the ones implementing the budget and being held accountable to it. So they need to have a copy of it. And next, we are ready to put the budget into action. And yes, that means that approved budget needs to be entered or uploaded into your accounting system. And then finally, you want to start monitoring the budget against actual results. And while it may be tempting to want to revise your budget as new information emerges and you start to understand your variances, remember, your budget is static. This is where a forecast comes in. So Carol, take it away.
So we have finally moved into our next topic, forecasting. Let's take a deep breath as we begin this next section. And while you're doing that, you can remember to drop your questions in the Q&A widget. I see a lot of them in there, and we're trying to address them as we go. But we will try to definitely address them at the end of this presentation. So forecasting helps answer an important question. If we already have an approved and even a surplus budget, why do we need a forecast? Because forecasting allows an organization to anticipate the challenges. It allows you the opportunity to make informed decisions and maintain stability by spotting potential shortfalls or opportunities early. So with that, let's go to the next slide where we talk about what is forecasting. So simply put, it's an adjusted operating plan. Your forecast is an adjusted operating plan. So again, we've been saying over and over again, where the budget is static, the forecast is fluid. Forecasting is a financial planning tool that projects future revenues, expenses, and cash flow based on the actual data and updated assumptions. A forecast is dynamic and continuously updated. Financial forecasts require monitoring and updates to keep them as accurate and as useful as possible. A rolling forecast is meant to be a tool that helps an organization look ahead and attempt to project what the financial health will be down the road. Cash flow forecasting in particular is a critical tool for identifying potential financial trouble that may require immediate attention, such as warning signs for increased borrowing. I know of a situation where the CFO had been hiding the fact that the cash gaps were being plugged by the line of credit draws. And the board didn't realize it until much later. And then they had to make up for lost time to address that issue. That's not a situation you want to be in. So Jen, I know you have also a similar experience with your clients and rolling forecasts.
Yeah, I think one that usually comes to mind for me is an organization I work with that has those, pesky 3 payroll months twice a year, like I mentioned earlier. And we were able to build a forecast and see that there was going to be a cash shortage coming in December, which was a 3 payroll month. And the organization was able to act early and I would say with minimal panic. So the ED was able to get approval from the board to draw from the line of credit, but they were also able to request a donor to accelerate a pledged payment. And so the forecast really gave them visibility to managing their cash flow and avoid a payroll funding crisis.
So that's a great example. Thank you for that. And speaking of examples, let's first look at our first forecasting example, which is a short-term forecast.
So here it is, a short-term forecast. And this really is going to be a tool that does exactly that. So it's going to project your immediate cash needs, which should typically be for a period less than 3 months. So you'll be looking at making sure you can cover payroll, payables, and other near-term obligations. So it's especially useful when cash is tight or when your revenue is seasonal, or maybe you have some large upcoming disbursements that are due. So this is really a great place to start. Weekly forecasts will simply roll beginning cash balances forward by adding your expected receipts and subtracting your planned payments. So even in a short-term view, you want to still factor in restricted cash to make sure you're appropriately spending that. And also you want to make sure you take note of other available cash sources like a line of credit. So you can see at the bottom of our example here on the slide, we've documented that information so that it's visible.
So like Jen said, this type of forecast is very useful when you're closely managing cash flow to ensure short-term liquidity, right? So I have actually used this for my clients on a weekly basis. So they were waiting for their funding to come through from their federal, state, and city reimbursements or funding sources. And they needed to know how much cash they were going to need to make payroll and how much was going to be available for certain vendor payments. So I would prepare this for the immediate week that we were in, scheduling out, what their inflows and outflows were for this week, and then projecting the next week so that they would have some sort of projection of what they would need to be doing if they had to tap into that line of credit for the next week in order to cover their expenses for the week. So now that we've looked at, the short-term tool, let's look at the bigger picture, and that's where our mid-range and long-term forecasts come in. So a mid-range forecast is a tool we use a lot with our clients here at YPTC, and we always recommend. We also refer to this as a rolling forecast, and we're also going to show you how we turn it into a rolling cash forecast. The rolling forecast looks forward, unlike financial statements, which, look backward. It combines actual results with forecasted amounts to project year-end net income and cash balances. And by the way, I saw something in the question that asked what was the difference between change in net assets and net income. They're basically the same thing. It's different wording for nonprofits. So we're going to be combining, we're going to be covering a 12-month period, and we can roll it forward continuously for future planning. It aligns cash flow with the organization's strategic priorities, such as annual budgets, expenditures, and expansion opportunities. For nonprofits specifically, it helps align cash flow with fundraising goals and grant cycles. So what are the benefits? It provides you that big picture view of financial health for informed decisions. It's essential for nonprofits to plan proactively and not reactively. And a well-developed forecast should be compared to the budget, highlighting variances that prompt management to ask critical questions and plan proactively. So this begins the section where your finance team need to really roll up their sleeves and dig in. So I like to say, buckle up. With this information, what do you need? What do you, your forecasting rather, what do you need to build this forecast? The good news is you should already have a lot of this information. We've already discussed several of these items in detail. So we talked about the financial statements. You're going to use the detailed revenue and expense data from your organization's financial statements. This is going to form your actual portion of your forecast, and you'll see that in our example. Monthly data is the best because it shows real-time trends. You're going to want to start with your beginning cash balance. You want to confirm that that beginning cash is in agreement to your audited financial statements or your adjusted general ledger. You have to ensure that your cash balance is in agreement to your reconciled accounting records, because if it isn't, you're going to start with an incorrect starting point, and it's going to make your forecast unreliable. You want your final approved budget. You want to use that your organization's approved budget, and you're going to allocate it by month. Monthly allocations matter because seasonality and timing significantly impact cash flow. And the assumption schedule, Jen mentioned this. Document assumptions for major forecast components. This helps track your changes and provides clarity. Start with details from your budget to avoid duplication and keep budgeting and forecasting formats aligned.
So let's bring Carol's words to life here and walk through a few visuals. So on the screen, the slide is a mid-range forecast that would be created at the beginning of a fiscal year. So in our example, that's July. So at this point, the forecast is identical to the budget. which you should be able to see in our fancy orange box here that highlights where everything is the same, so no variances. So as Carol mentioned, starting point is approved budget by month. So all we've done here is we've inserted an additional total column for the forecast, which will now sum all the columns to the left. The budget column total will remain static. Say it with me, will remain static, right? Now we're ready to start using the tool. So at this point right here, you now have the basis for a rolling forecast. And with just this schedule, if you use it appropriately, you can start projecting your revenues and expenses for the year and in real time, compare those projections to the approved budget and start looking at your variances. So let's look at how to start using this tool. So as the year progresses, we're going to continuously update that monthly information by first replacing the budgeted amounts with the appropriate actual amounts. So as you can see here, we have replaced the budgeted amounts for the period July through January with actual results. And again, that information is going to come straight out of your accounting system that flows right into your statement of activities or P&L. You can show the actuals month by month like we have here, which, as Carol had just mentioned, that makes it easier to spot changes and trends. But alternatively, it's a little easier on the eyes if you replace those monthly actuals with a year-to-date column instead. So it's totally up to you. Next, we will start adjusting the future budgeted months. So for us, that's February to June. And we're going to update that with our forecasted results. And that's really going to reflect the new and relevant information that has become available to you after the budget was approved. So then your forecast total is going to sum together the actual and the projected months, which can then be approved against our, can then be compared against our approved static budget total. So then we can see that we've got variances and we can take prompt action if necessary. So next, let's take a look at our rows. So that's where we start with our revenue items first. So as you can see all the way on the right, we're showing variances here. We are not just plugging the remaining 5 months of the year to meet the budget. We often see that, and that is not the point of a forecast. We want to see realistic assumptions and factor in seasonality and trends. So for instance, Carol talked about summer camp before. If you take a look here, that's being projected when camp is being held. Same thing for special events revenue. It's being projected when the event occurs rather than, spreading these items evenly over 12 months. So next, we continue with our expense line items, followed by that subtotal for the change in net assets or net income. It's all in the same format. So picture all of this on one page. We've just separated it here into 2 slides so that you have even a shot at reading this. So again, same idea. We want to be factoring in seasonality, trends, and matching expenses with revenue. So if we go back again to that camp example, you can see here that the camp programs and activities expense line item has actual results in July and August, and then forecasted for just the month of June when camp starts. And again, we're showing variances. We are not just plugging to the budget.
Okay, when any activity is not assigned to the appropriate month using a fairly good estimate of what is expected, you're likely to get some wonky variances. That would likely call into question the reliability of your forecasts. And as you look at the change in net assets, you should be asking yourself if the results seem appropriate. Does it seem realistic that you're not covering expenses July through September and then again January through February? According to this rolling forecast, the organization is doing significantly better than budgeted by the end of the year. Does it make sense? Are there any other areas that can be improved, that can be done before the end of the year? Should more of the line items be evaluated? These are just a few examples of the type of questions you should be asking and addressing proactively when you use a forecast. So let's turn this rolling forecast into a rolling cash forecast. This is definitely a more advanced approach to forecasting. This is also where your GAAP accounting skills will come into play. So why do we add this section? Simply because GAAP income is not cash. These line items are included in the cash adjustments. They represent changes in your balance sheet or your statement of financial position. We are reconciling your change in net assets, which is on accrual basis, to your net cash flow. This section also shows changes not captured on the income statement. We recommend that every financial package, whether you're receiving a monthly, quarterly, or annual package, include a cash activity report. We find it insightful to review and understand the adjustment from your change in net assets to your cash balance. So these items highlighted in orange come from your statement of financial position. These line items represent the changes in your balance sheet account, specifically the monthly increases and decreases. I'm not going to talk about all of these line items. Let me just highlight a couple. So we're going to talk about that depreciation again. So depreciation is an increase in your accumulated depreciation on your statement of financial position. And as I mentioned, it's also a non-cash expense. So you want to adjust that when we're trying to calculate your cash flow. Your line of credit, it's borrowed cash. It has a positive impact on your cash flow, but it's not included in your income statement. In our example, I always stumble over that word, right? This fictional client, their cash was sufficient enough to pay their outstanding line of credit in August, October, and November. However, their cash balance would have gone negative and remained negative until management took action in February and June. So these adjustments are key tools to managing the organization's stability. The cash items subtotal represents adjustments that cover GAAP income or loss. And Your cash in items subtotal represents adjustments that convert your GAAP income and loss to your cash income and loss, which is represented as your net cash flow. We do this on a monthly basis, which flows through to the forecasted total. In this example, you'll note that we included in our budgeted totals the impacts to cash as part of our budgeting process. And there's two things to say here. When you start this process of overall forecasting, you're budgeting your cash adjustments. When you do that, it'll get easier. You want to simply start by just estimating those line items that you know from experience, or maybe even pulling it from your audited financial statements. When you budget for these cash flow items, you're now going to see a variance. You're going to see a variance of forecasted cash to your budgeted cash. And again, this is triggering meaningful conversations. So in our example here, the budgeted cash of $121,000 will only cover about 1 month of expense. It will not, rather, cover more than 1 month of expenses. In fact, the forecasted ending cash of $269 likely only covers 1 full month. So again, the budgeted cash of $121 was not going to cover 1 month of expenses. The $269 will likely only cover 1 month. And if you remember, we recommended that you should have 3 to 6 months of cash reserves. So, and in this situation, we've already tapped into line of credit to, cover the gap. All of this is to emphasize the point that the budgeting for a deficit, when you budget for a deficit, creates stress and complications. It can take you need to take some corrective actions by implementing this forecasting process so that you can control it and predict what you need to do next. One last point, consider that the forecast cash should be your available unrestricted cash. So if your cash is commingled with your restricted funds, you may need to add an additional line at the bottom under ending cash, taking out the restricted funds to get to your true available cash for unrestricted operations.
Our screen is now orange.
I know. It was a lot of information. It was a lot to take in there.
Yeah, I mean, we know this process can be intimidating, but again, there's no need to stress. Just start simple, start with what you know and build it from there. Your budget will become your forecast, and your forecast is going to lead into your next budget. So the more you do this, the more comfortable you'll feel and the more accurate your budgets and forecasts will get.
So we're in the home stretch. We're in the home stretch. I know we have a few minutes left here before we open up for any questions if people are going to hang out. You want to step back and look at the bigger picture. Your long-term forecasting helps organizations understand their trajectory over the next 3 to 5 years. It identifies long-term revenue trends, the expense growth, and overall financial health. It aligns your financial planning with strategic goals like growth and sustainability. It provides a high-level view of future operations without the detailed cash adjustments. Yes, your cash planning still matters. You want to ensure that you have liquid resources for the future, but this is focusing on the high-level operating activity. The overarching goal is growth and sustainability. I've said it, not the specific year-to-year changes in the individual line items. So you want to be asking yourself big picture questions. Are your revenue projections realistic and backed by trends? Do you have the contingency plans if contributions, or in a fixed example, rental income falls short? What external risks, like the economy, regulatory, or operational, could affect your projections? Ultimately, the long-term forecasting supports your strategic decision-making, adaptability, and sustainable financial health.
I thought you were asking me all those questions, Carol. All right. Yeah. All right. We've made it to the summary. We did it. So now we're just going to walk through quickly for your reference some of our take-home slides here. So the one pictured here on the screen, this really is a summary of the key points related to cash management, budgeting, and forecasting.
And if you're wondering where to start, organize your next steps by using this checklist. This is your 90-day action plan.
Your homework.
Yes.
And keep this list of key questions handy. So you want to make sure that your budgets and forecasts are answering these questions. And we see it, there's a lot here. But again, take it step by step, do what you know first, and keep improving it as you go.
We've provided you with some additional resources here. Our webinars can be accessed as recordings. These are great free resources for you and your board to check out, especially when onboarding new members.
And then, as we mentioned earlier, here are just a few suggested tools that we've seen nonprofits leveraging to help automate their budget process. So you could certainly check some of these out to see if they would be useful and affordable for your organization. And that brings us to Q&A. Thank you, everyone, for joining us. We're happy to stick around and go through some of the questions that we were not able to get to yet. And I just want to remind everyone, sorry, Carol. Before we do, I just want to remind everyone, if you are leaving, make sure to please fill out the evaluation survey. We really do value your feedback. All right, Carol, go ahead. Sorry.
Sorry about that. I see the question. Well, I know. I saw one about the in-kind, and I was hoping to get to it as part of our presentation here. So I want to make sure. First off, when you're putting budgeting for in-kind, there really is no minimum. You're saying here, is there a minimum market value that is used to determine when to include the budget? Not really. Nonprofits have always been required to report on in-kind. So if you're reporting on that in-kind, you really should think about budgeting for that in-kind, whatever it is. So if you're a camp and you're getting food donated, and remember, it is for professional services or otherwise services and goods that you would have to pay for. So it's not necessarily volunteer. It has to be specific, to professional. So say you get pro bono legal services, you're going to want to record that. If you're getting pro bono accounting services, you're going to want to record that. So no, there's no minimum, minimum value. It's really what you think you're going to be getting during the course of the year.
Carol, there's one in here, do I need to include depreciation in a budget or forecast if my organization does not own any tangible assets? So I would say to that, if you don't currently have any fixed assets, right, you would not have anything to depreciate, but you want to be thinking ahead. We're looking forward at this point, not back, right? So if you are planning to acquire anything that would get capitalized on your statement of financial position, you should be budgeting for that depreciation. Because remember, when you purchase it, it goes on your balance sheet as an asset and the cash goes out the door. And then that asset is written off to expense over time in the future. So depending on what your capitalization threshold is, if you plan to buy, something large like a vehicle for your programs, or I don't know, a large expensive computer, you may need to be planning to record that depreciation. So we suggest including it in your budget. Again, it's just going to create a variance that you have to explain. So we think it's better to just include it and then back it back out at that bottom in that orange section where you're adjusting the cash.
Yeah, and I tried to cover that as we were going. I'm curious. So there's another question here about curious to know whether you have any clients that have stopped having a gala or an annual fundraiser and the effect of that action on their revenue. Well, clearly that's not helping their revenue. So we gave you, when you get these slides, you'll see that somewhat of a template there that you could build off of to project what your net revenue would be for a fundraiser or your gala. And that's really critical for deciding whether or not to do it. Because if you're spending more than you're bringing in, or you're breaking even, then what's the point of that? Is it to bring in potential funders or donations? I think you really need to budget for that. And yes, it has happened where I have had a client who decided not to do that, and it was a negative impact to their revenue, and it was something that they then had to recover from. So if you're going to pull out that gala, you're going to pull out that fundraiser, you need to have an alternate. If you're taking that out of your budget, what are you putting into your budget to bring in that revenue that you may be relying on for unrestricted purposes? Because that's typically what your gala is doing, right? Any thoughts on having the board approve a preliminary budget in November and a final budget in February for a fiscal year in December? Ooh, this one's, I'm going to go with the conservative approach here. I'd rather have that board approve your budget in November and then use the forecasting for any changes that you're making along the way, and have that conversation with your board to say, that would be my approach. Now, Jen, you may have seen it differently. Maybe there's reasons for it. Maybe you're waiting for a grant coming through, or you're waiting for a big project to be approved. So there is that, opportunity, I guess, to have a preliminary budget and then go back and revise it. But that really is why we do a forecast. So you would prepare what you know now in November, start out your year in January 1, and then in your forecast say, oh, we now got this new grant. So we're going to revise our projections for then. Oh, it may also impact your salaries, your biggest expense. You may now need to hire more people. So I would rather you do the budget with what you know now, and then fix your projections in your forecast once you know the additional information or the new information. That would be my recommendation.
Yeah, I would agree. Once you start your fiscal year, you will go in with the budget. We said it at the very beginning, like 3 hours ago, that you are making your budget based on the best information you have available at the time. Anything you learn after that goes into your forecast. So, December year end, go with your budget and then make the changes. I've only seen a handful of instances where an organization has actually approved a new budget once their fiscal year has started early in the year. And that was only because of something catastrophic that happened, like they lost a major funding source. And they decided it would make more sense to just approve a new budget because they were going to have to take drastic actions. So again, rather than explaining a bunch of variances all year, they took the approach of approving a new budget. It's really up to management and the board how they want to handle it. We just think it's easier. Go with your budget and then tweak it as a forecast the rest of the time, because you're going to keep learning stuff as the year goes on, and you'll take that into the next year when you're doing your next budget.
There's a question about, of all the controller responsibilities, how would you rank cash management? Well, I would suggest that it's right up there, and again, we know that some organizations cannot afford to have both a CFO and a controller, but that's where, you may need to lean on your board a little bit. but the controller would still have to compile all the data to make those informed decisions or provide the information so that you can have meaningful conversations. But cash management is definitely something that I would put right up there. That's where it's critical to do bank recs on a timely basis. And again, I would also suggest the interim reporting. So whether it's monthly or quarterly, you should be reporting to your board what is your, what's your available cash, because, your cash in your bank statement is not necessarily the cash that's available to be spent. There's timing differences to that. So there are a lot of critical questions that need to be answered as part of cash management. There's a lot of steps that need to be done by your controller to get to that point of having meaningful conversations. So yes, I would say that it's pretty high up there in the list of things to do for your controller.
Carol, there's a good question in here about, can we talk about how someone would analyze restricted cash on a monthly basis so that it's easy to link to the current month-end restricted cash and grant process? And that's a great question. I think a lot of organizations don't think to do this, or they don't have the bandwidth to do it because they just have so many other things to do. But it's really important, we mentioned earlier, to have an eye on how much of your true cash balance is restricted versus unrestricted. Not everybody creates separate bank accounts, and nor should they in all cases, to separate unrestricted from restricted. So it does become a bookkeeping exercise. So I like to use a net asset roll forward for this, which is a big snoozer of a topic, but it's something that we like to do is rolling forward our net asset balances for restricted and unrestricted each month. And then you can break that down further into where do those net assets live? Are they in cash? Are they in receivables? For your time restricted gifts? Are they sitting in your investments? And you can get at it that way. And if you track that, that's how you can really keep an eye on it when you're doing these types of forecasts, because you can be planning for what's getting spent with restricted funds as you're trying to project it forward. I don't know if there's another question to it, but there is a way.
Yeah, I know that. Yeah, there is a way. It's not necessarily easy. How do you budget for unrealized gains or losses? So I would suggest, what we recommend is looking at the history of what you experienced during the prior year to estimate what you think going forward, because that is probably just like, estimating for donors, right? You're not really sure how many donors you're going to have and what they're going to give. You're basing it on your history or your relationships. And with the market, you never know the ebbs and flows. So you want to make sure you have something in there, something that's realistic. If you had a big year, you may not want to budget that much, right? If you had a really bad loss, you may not have to go that deep. You want to have something that represents activity that seems realistic. So maybe it's even just based on the interest that you've had over the course of the year, so that it's something that you can say is static, and then just explain the variances. Remember, it's not supposed to be perfect. It's just supposed to be an estimate of what you think could happen during the course of the year. Don't over budget, don't under budget. Find something that falls in the middle. And then as you do your monthly analysis, explain the variances. People will know when the market's good and when the market's not.
So Carol,
but do budget for it.
I was going to say you could also play devil's advocate here and not budget for it, because it is something that's very uncertain. It will create a variance, but I have seen many organizations that don't budget for the gains and losses. They only budget for the interest and dividends, because that's a little bit easier to predict. So really depends on your process, your comfort. If you have maybe an investment committee that can help. Looking at your history
exactly.
is certainly a great idea. That's one of those areas, sort of like planned giving, right? Like, does past history really predict the future, what you're going to get, so kind of go with what is what I would also suggest.
Yeah. And investment committee is really a strong, a strong advocate for that. I know I have clients who they say they expected to make X amount of dollars. And so we budgeted based on what that investment committee recommended. And then when it doesn't hit the mark, we have to go through the variance analysis. It really is dependent upon your tolerance for variance conversations. I typically would like to see something, but Jen's, giving you another perspective. I think it's a matter on your tolerance for variances.
Let's see. What have we not covered?
We talked about depreciation. I think we've covered that one. What is a good explanation of depreciation to non-accountants? I think we've talked a little bit about
Yeah,
that.
I think that's mostly timing. It's just something, it's an asset you're writing off over time instead of at the time you purchase it. There's a question.
There's a question about, go ahead.
Me first. All right. What actions can an organization take if they have no reserves and no line of credit and they're unable to cover expenses for a single month, but is anticipating revenue, but not until after the expenses need to be paid? That's a tough one. And that's why we want to be forecasting so that we don't end up in that position. When your financials look good, get that line of credit while you can, and that way you'll have it available to use. Most organizations wait until they need it, and then it's harder to get because their financials don't support a lender wanting to lend to them. So always also having a plan in place of what are you going to do in those situations so that you don't have to anticipate it or figure it out on the fly. You know, we've seen some people run up their accounts payable, right? Your vendors do not like that. Sometimes you have to delay purchases. We know you have to pay your people, right? So you have to kind of prioritize what you're spending and plan accordingly. It's just like your checkbook at home, right? If you don't have the money, you shouldn't do it.
But you have to cover payroll. And I have a client who, when they find themselves in this gap, they've actually reached out to their board. You know, the board then will try and find a solution to filling that gap on a temporary basis. If you're fortunate, sometimes you have a board who will make a loan to the organization on a short-term basis, that because they know that the money is coming back to the organization. So, but reaching out to your board for solutions, that's why nonprofits have boards. It's not just on the executive director's shoulders. It really is an opportunity to reach out to your board and say, what are some of the solutions we can consider here? And sometimes you're fortunate where the board will step up and say, we can fill that gap temporarily because we know that there's money coming in. It's just a timing delay. There's a question there, Jen, about, do you have any advice for grant forecasting from year to year in this highly volatile funding environment? Struggling with forecasting for a grant, but then getting denied for one reason or another while also building up a pipeline. So I mean, Jen, you have a great example with one of your clients where they do high, low, and medium, right? Where it was they would project and say, this one's high probability we're going to get it, this is low probability, and this is somewhere in the middle, right? So those low ones would not be on the forecast because, you know, we didn't want to be, we wanted to be conservative, right? Versus the high would definitely be on there. And then the medium really related to the, you know, we had to have those conversations about relationships and potential, right?
Yeah, absolutely. So that's part of, you know, assigning probabilities to your revenue when you're looking at it, making a decision on what ends up in the number in the budget and what makes that up. And then you have your, you know, your high, this is great. Then you have your low, this is what we might not get. Some people do it in percentages, what percentage they might get it. It really depends, but this is where scenario planning also comes into play, and diversifying revenue. So thinking through, you know, you can have a realistic budget, a stretch budget, you know, and make those choices about which one you want to actually approve and how do you get there. Maybe you get to a happy medium. It's not easy budgeting and forecasting for grants because, you know, you are applying and there is a decision to be made. They're not guaranteed. Federal funding has been tough. And that's why really, if you can forecast for multiple sources of revenue, you know, you may not get them all, but hopefully you'll be able to get a sufficient amount to be able to cover your expenses that you budgeted.
And foundations are struggling right now. I don't want to say struggling. Foundations are flooded, I would say, with applications, but I would definitely take every opportunity to research what foundations may have available funding, and to the extent that you have the resources to complete those applications, and because you actually may fall into the qualifications of it, you should absolutely take action to do it. Another question regarding deferred income expenses. Deferred income expenses. We quite frequently send invoices for camps in the following year and book them as customer deposits received and journal them into the new year. Is this correct? We do the same with prepaid expenses. So we talked about how camp revenue is earned revenue, so therefore you would have possibly deferred revenue at the end of 1 year, because it's maybe they paid in full, and your June 30 year end, and your camp runs June, July, and August. So you could possibly have deferred revenue sitting on your books at June because somebody paid the full fee. And then you would bring that into your revenue, as you said, journalizing it back into your revenue as it's earned. And again, same thing with the prepaid expenses. As they're incurred, you would then allocate them to that month as they're incurred. So yes, that is, we have a lot of clients with camps, and you'll see deferred revenue for tuition, you'll see deferred revenue for camp, and you just have to be very mindful of then bringing it into the month that it's earned or incurred in the account of expenses.
Right. On that
So
note,
I think we're wrapping it up, right?
We're wrapping it up. I was just going to say, I think we're out of time. So thank you, everyone who still stayed. Again, your feedback's important, so please fill out that evaluation survey. Thank you all for joining.
Thanks, everybody. Have a great afternoon.